Hi everyone. Welcome to another episode of Game of Investing podcast. And in today's episode, I'm going to tell you about the fallacies of dividend investing strategy. There is so much rage, so many videos circulating around why investing for dividends is a great strategy. Well, let me tell you, if you're like me trying to create wealth through investing in solid quality companies and try to compound the portfolio, then dividend investing will make us poorer. Dividend investing is not for people who are trying to create wealth in the markets. Dividends are basically, in its fundamental form, what is a dividend yield? A dividend yield is nothing but the dividend per share divided over the share price, per share price. A dividend is paid by a company from its earnings that the company generates by selling its products or services, and from that earnings or the profits, the company pays off a certain percentage to the shareholders back. Now, there is nothing wrong with that strategy. But most of the stable, big, matured companies, they don't need the capital back to be deployed in the business. They don't need the cash because they are solidly generating free cash flow year after year. So they don't need additional capital to grow the business, and they don't have probably growth avenues. They are kind of saturated in terms of their growth. There are super large companies out there who are growing less than 5%. What do I mean by growing? I'm talking about the revenue growth. Revenue growth should be at least 10 to 12%, and the earnings growth should be at least 15 to 20% if you want to compound your portfolio at 15 to 20% in a steady manner. Now, what is dividend yield? A company that pays 5% dividend yield or anything above 3-4% dividend yield is a company that is giving you a clear message. Look, we don't have any avenues to grow. We are giving back the money, whatever earnings we are generating, we are throwing it back to the shareholders. We are distributing it back to the shareholders, which means they are not requiring the capital back to be redeployed. Neither they do have any acquisition strategy or acquiring strategy because they are not looking at inorganic way of growing as well. So companies which have that kind of a mindset pays dividend yield, steady cash flow back to the shareholders. Well, dividends are for people who are already super rich, who are having a net worth of more than $3, $4, $5 million. Suppose a person has a $5 million portfolio or net worth. Now, if that person can afford to put a $2 million in a dividend yielding portfolio and $3 million in a growth oriented portfolio, in a combination of which gives you tremendous results in the end, right? Because imagine $2 million portfolio that generates a dividend yield of 5% can give you an annual cash flow of $100,000, which is sufficient enough for any family to live their expenses off. Or suppose you are retired and you have a $2 million corpus. Those are the people who do not want to take heavy growth, high growth companies and take heavy risks, right? For them, a $2 million portfolio that fetches $100K per year is good enough. Now, there is a hybrid strategy I would recommend if you still want to invest for dividends, some percentage dividend yield that is yielding you some cash flow year after year. Nothing wrong with that strategy. Hybrid strategy is actually an optimal way of compounding at 15%. At the same time, you get a 1 to 1.5, 2% dividend yield. Now, look for companies that has at least 10% revenue growth and at least 1% dividend yield. That's how I put it as a combination, and I filtered and got the best companies out there, the solid 10 companies, which are so strong brands, strong moat in Warren Buffett's terms. These companies have been existing since over 10, 20, 30, 40 years, and they are going to exist and grow at least 8 to 10% in the near future. So you get a benefit of both, right? You compound at 12-13% earnings and you get a 2% dividend yield. Put together, you're compounding at 15%. So you're handsomely beating S&P 500 index, and at the same time, you're getting a steady cash flow of 1.5-2% yield, which is a great strategy. So the conclusive message from today's podcast is: do not invest only in dividend yielding stocks if your net worth is less than $1 million. Period. Your idea is, like, if your net worth is $100,000, $50,000, whatever that amount today, your idea should be to make that, convert that, compound that money, putting in a quality companies like 15 or 20 of them that has growth orientation and that can compound and create like $2 million, $3 million retirement corpus for you over the next 2 to 3 decades. So to achieve that, you need to create a portfolio of companies that are in growth phase or at least steady growth phase, right? And look at a hybrid strategy that doesn't hurt the way I showed a portfolio. And once you reach the $2 million, $3 million mark, then you can put a $1 million for a 5% dividend yield, fetching you a annual cash flow of 50K that can fund your annual expenses. That is great. But until then, do not only invest in dividend yielding stocks. So that's a message. Signing off, Sandeep Anand.